For those that don't know me, my name is Brandon Mossbrook. I'm the Chief Investment Officer and Vice President here at Midwest Financial Group. We're also joined by our President and CEO, Matt Coupland, as well as Ethan Miller from Lord Abbett. Before we turn it over to Ethan today, just a little housekeeping. Everybody is muted and will remain that way so that we can keep everything moving through. However, should you have a question that you would want to present to Ethan, myself, or Matt, please feel free to use the question and answer function in the Zoom meeting, either on your tablet phone or desktop computer. And we will be sure to try and get it answered. If you have any direct questions for Matt or myself, feel free to follow up with us afterwards, and we will be more than happy to get that information to you. And with that, I will turn it over to Ethan to get the presentation started.
Sounds great. Can you hear me, Brandon?
Yes.
Perfect. If you could, I think you just have to give up sharing your screen and then I can share mine. There we go. Perfect. Well, thank you everyone for just a couple minutes of your time here today. I hope that this finds everyone safe, healthy, and hopefully looking forward to a good weekend here with some weather on the horizon. But so I work with Brandon and Matt and the rest of the team on the investment side. So I work for Lord Abbett, who is an asset manager based in Jersey City, New Jersey. Lord Abbett has been around since the 1920s. So we were founded in 1929, having just celebrated our 90th birthday, so to speak, of working with clients and helping manage their wealth. And today, the goal of the presentation isn't to give you an estimate of where the S&P is going to be at the end of this year, or what is your portfolio going to be up or down over the next 12 months, because I don't have that crystal ball, unfortunately. What I'm going to talk about today is talk about some of this recent volatility, both on the equity and the bond space, put it into some historical perspectives, but talk about, again, the alignment and what we expect moving forward from just a market functionality standpoint, and what we're seeing as far as opportunities. But like I said, unfortunately, we don't have that crystal ball that can tell us just where we're going. So to kick things off, I did want to start here. This is a great chart that I think can really put into perspective what we've seen so far this year. So as of this morning, the S&P, the broader equity market, domestic equity market, is down just over 10%. Year to date. Obviously, it's been a little bit of a roller coaster ride over the last 5 months, from up to down to 30%, and now having recovered a little bit from the bottom. But it's interesting to note that, so I just moved to Wisconsin 2 years ago, and I'm quickly learning this, that just like the weather in Wisconsin can be a little bit tricky day to day, it's the same thing with the market. We invest and we live in a market of extremes, not averages. Because if I told you before looking at this screen that over the long term, so if you look back over the last 90 plus years, that large caps US stocks have returned 10% on average, many would think that, okay, if US large cap stocks have returned 10% on average over the long term, then probably the market has returned between 8 and 12% most often, if I'm looking back over the last 94 years. But again, this is a market of extremes, not averages. So the tough part, or the great part, is while you can earn those averages, whether you're looking out over 1, 3, 5, or 10 years, doing it year by year isn't the best way to judge performance. What you'll see here is the market has actually only returned between 8 and 12%. So the market has only been average 6 out of the last 94 years. 6 times the market has been quote unquote average. The same amount of times that the market has been average, the market has actually been down 20% or more. It's kind of mind blowing when you think about just how extreme, how you land on that 10% number. But if you look all the way to the right, what you see is while the market has been down 20% or more 6 times, the market has been up 20% or more 35 times in 35 years. So overwhelmingly, not only is the market positive more than it's negative. You'll see here, you've had positive returns 69 out of the last 94 years, coming in at right around 75% of the time the market has returned positive. I don't know about any of you in the room, any gamblers or enjoy Vegas, but if I had those odds, I'd be sitting down at the table. The problem is, too often, whether you're looking online or if you turn on the TV and you happen to tune into whether it's CNBC, Bloomberg, CNN, Fox News, don't care what kind of news station you're looking at, they don't speak about it, again, in the eyes of a financial plan. They're talking about what did the market do in the last week? What has it done over the last 6 months? Very rarely do you hear what has the market done over the last 5 years. And even though the fact that the S&P 500 is down 10% for this year, over the last 5 years, even with this recent downturn, the S&P 500 is still up close to 50%. Again, that doesn't get talked about as much because it's not catchy. It's not going to get you to sit through the commercial break. So one of the things I always stress, and this has very little to do with the actual market, but is the amount of information that we're getting every single day is also extreme. Just like being home for the last 2 months has been extreme. There is a flurry of information that's being sent every which way, whether it's through email, whether it's through Twitter, whether it's through your Facebook feed, or like I said, or whether it's when you turn on the TV. It's important to take a step back and, again, remember to separate some of the facts from fiction. You can turn on the TV and they're going to tell you that the sky is falling. The stock market might be going to zero. But what's the goal of all that? Is it to give you sound financial advice? Or is it to get you to listen through the commercial break so that their advertisers can be happy who pay the bills? Again, in Lord Abbott's opinion, we don't see, I don't know where the S&P is going to end up, but the sky is not falling. The stock market is not going to zero. In our opinion, when it comes to the coronavirus and getting to the other side of this, it's a matter of if, not a matter of when we do that. Because there's just a lot of uncertainty around the health side. But one thing that's difficult is, again, when you're hearing all these maybe positive, maybe negatives, is it brings a lot of emotion into the decision. And when you think about, again, setting up a financial plan and working to meet your goals of the long term, arguably the best thing to do is to take emotion out of the equation. Because say you're in one of these years, one of the 14 years in the last 94 where the stock market returned 0 to 10%. One of the most easy things to think is, well, if the stock market's going down, what I can do is I can just sell out now. The market will continue to go down, and then I'll just buy back in when the market's going up, because I can win by not losing, essentially. But it's nearly impossible to do that. Trust me, many people have tried throughout the years, and most fail because it's like I said, the market is anything but average. It's a market of extremes. And two is what actually ends up happening is some of the best days of the market come after some of the worst. Now, this is a study that has, you might have seen it before, and you might have heard it from the MFG team, but it's an interesting study. So what we did is we took a look at the last 9,125 days. Now, this is through the end of 2019. So we looked at a 25-year time frame, and we didn't cherry pick the dates. I mean, you'll recognize some of these dates. It was through the tech wreck of 2000. It was through the great financial crisis. It was through the U.S. debt being downgraded. It was through 9/11. It was through the trade war with China. I mean, there were some volatile times during this where it could have been easy to just say, I'm going to try to time the market. And what you'll see is throughout this study, we took a look at what had happened if you invested $10,000 25 years ago and just held it throughout. You didn't sell out. You simply kept your head down, took emotion out, and just held on for the ride. What you'll see is if you were invested all days during that period, yes, there were some bad days. Whether it was, again, September 11th when the market sold off, the tech wreck of 2000, the great financial crisis. Yes, your portfolio, there were days where it was down, but over the long term, your $10,000 grew to $112,000 over that time frame. But if you go to the next column down, what you notice, so what we did is, well, what happens if you miss just the 10 best days? So think about that. If you miss just the 10 best days out of 9,125, what happens to your portfolio returns? Your initial investment of $10,000 doesn't grow to over $112,000. It gets cut in half to $56,000. You earn 50% less on your investment because you, again, try to time the market versus just keeping your time in the market. So again, when you think about not just from a portfolio return standpoint, but your plan, your long-term goals, and why you're investing, if you can get to the goal line, to use some football analogies, and you're about to punch it in by having $112,000, or the other option is, well, I'm going to try to time the market, and you're now back at the 50-yard line. Like, how many more years does it take to make up that difference? So by trying to time the market can really hinder a lot of your long-term financial goals and needs. And the good news is, through your portfolio construction, it's not just about equities. So a lot of this is just looking at what were you invested in equities. The good news is there are abilities to smooth out the ride. It's why you own both bonds and stocks. Now, Lord Abbett is very heavy in the bond space. So I get the question all the time, especially over the last decade, was, well, why am I owning fixed income? My stocks are going up and my bonds just aren't going up as much. The good news is, so far this year, again, bonds have really kind of showed their role in a portfolio. And now, so we're going to transfer over to a little bit what happened to the bond market, what is the bond market, and go through that. But I think it's interesting to note, what you'll see on the screen is the U.S. bond market is actually bigger than the stock market. But I would argue everyone on this call knows more about stocks than bonds. Because what's interesting to note is a bond is not a bond, and there's also not a bond. So I'll explain what I mean. So the U.S. bond market is $38.9 trillion in size. But if you take a look at this next chart, there are many different ways you can paint a bond. You can't paint all bonds with the same brush. There is the most commonly known bonds, which are Treasury bonds. So these are bonds that are backed by the U.S. government. They're considered the risk-free rate. There are corporate bonds. So you think about Walmart, Target, Delta, different names. They can issue bonds as well. Those would be, again, not as a little bit more risk to them than a Treasury bond, but not as risky as something like high yield bond, which could, as you'll see, can be some of the top performing bonds in any given year, but can also be some of the bottom performing. So with the bond space, or you want to stay diversified, because every year, just like in some years, the growth side of your equity portfolio outperforms value. Maybe the domestic outperforms the international. Bonds, too, can have a variance in performance. And what you've seen so far this year is much like what you saw in 2008, for example. So what you saw in 2008 was the least risky part of the bond market held up the best, because equities were selling off and investors were nervously piling into risk-free portfolios, much like Treasury bonds. And the good part is what bonds allow you to do is to buy low and sell high, because while people might be selling in and out of the market trying to time it, what we just alluded to, the best thing to do is keep your equities invested. What bonds allow you to do is you can be buying from your bond positions and reallocating the equities to take advantage of some of these dislocations over the long term. So this is just looking at year-by-year performance. I think when you put it into the grand scheme of things of an overall portfolio, like I said, our crystal ball is just as foggy as everyone else. We have a little bit more insights because this is what we do for a living. We've been doing it for 90 years. But no one knows what's going to be the best performing part of a portfolio over a 12-month window. What you'll see here is there's very little rhyme or reason over the last 20 plus years, 30 plus years, what's been the best performer. So it's important to stay diversified. But the reason why you own equities and bonds in kind of the most simplified form is, so far year to date, the best performing asset class is fixed income. The Barclays Ag is up over 5%. Again, at a time where the S&P 500 is down close to 10%. However, in our opinion, the best investment you can make is investing for a recovery in the thick of a recession, which is why, again, sitting down with the MFG team during this time and kind of assessing your risk tolerance, where do you see yourself 6 months from now, and possibly making some tweaks could set you up to kind of get ahead of your financial goals versus having to play catch up on the other side of this. And this isn't a new concept, but if you read a lot in the news on kind of the quote unquote, what the smart money's doing. So what the smart money refers to is the institutional investor. So these are people that are investing billions of dollars, and sometimes trillions of dollars at a time, versus $100,000, $500,000, $1 million. But the good news is, the same way that they have been able to make so much money over the time and been so successful is the same process that I know for a fact, because I work with them, that the MFG team has enrolled in their practice. I mean, does this sound familiar, that you hire a financial advisor, you evaluate your needs and goals to come up with a financial plan, you have a different allocation buckets with different allocation mixes of stocks, bonds, domestic, international, cash. You select and hire managers, some of those being like Lord Abbett and many of our different peers, and then you monitor your progress along the way. Again, this is the same thing that we're doing when we work with our institutional clients as well. And what this process does is it allows to take out a lot of the emotion out of the decision. Because facts, as we just alluded to, studies have shown that it's time in, not timing the market. And that when you take the emotion out of the execution is when you can really get ahead versus having to play catch up with your financial plan. So I'll stop there. Hopefully we can open up the floor for maybe some questions that come in or had been sent prior, but happy to take a deeper dive if anyone likes or answer any follow-up questions.
Yeah, thanks, Ethan. We appreciate what Lord Abbett does. I think for a lot of people that are on the call or may watch this later, Lord Abbett has been such a big part of our preservation portfolio, our safety bucket. We talk to a lot of our clients about having a certain amount of money out of the market versus in the market and in the stocks. And you guys have done great for a lot of the people who are on this. So thank you and your teams for all that. One of the questions that I have or that came in was, what are the impacts, with interest rates going up or going down? I mean, what does that mean for some of bonds, bond funds and things like that? Do you have any thoughts on just interest rates and how that pushes around the bond market versus what it does to the stock market?
Yes. Yeah. So let me, if you don't mind, I'll go back to this chart that has year by year returns and maybe highlight a few. So yes, I mean, there's no getting around. We are in a very low interest rate environment right now. But it's important to note that while the rates here in the United States are low, we're in a very global economy today. So I always like to say there's $11 trillion around the globe that's actually trading at negative yielding debt relative to our just low interest rates of a 10-year Treasury, give or take around 60 or 70 basis points. So right now, the U.S. is essentially the fastest turtle in our race. Yes, ours is low, but it's actually high relative to the rest of the world. So we think that rates will stay lower for longer overall, but that doesn't change that there might be some times where they're going up or they're going down. The good news is, we kind of talked about a bond is not a bond is not a bond, that just like stocks, whether you're looking at growth versus value, is going to perform in certain market environments. Same thing with fixed income. So if you look in the year 2013, we saw interest rates rise pretty quickly. And what you'll notice is more of the corporate leaning bonds, whether that was high yield corporates or just corporates, outperform things like Treasury bonds. So when interest rates are rising, it tends to be an overall, it means that the economy overall is moving forward and growing at a good rate. which means that corporate America should be outperforming. So owning bonds that are more tied to corporate debt tend to outperform historically when interest rates are rising. Things that are tied to the Treasury bonds or correlated Treasury bonds tend to underperform when rates are rising. So in a year like 2013, rates went up. What'd you see? More corporate bonds outperformed relative to Treasuries. In 2014, rates came down. Now, while corporates outperformed, what you see is Treasuries came back up and high yield and other parts went down. So it's a seesaw of a bit. Overall, we do expect interest rates to stay lower for longer as we work through, just because so much of the rest of the world is even lower than us, which is hard to believe. But there are definitely parts of the bond market that can protect better in rising rate scenarios, and not all bonds go down when rates go up.
Okay, and a short pivot on that then, does Lord Abbett have a stance on inflation or anything like that? We hear that talked about a lot because, various reasons. It's a buzzword in the news. The U.S. government just spent a lot of money potentially helping lift up some of the effects of COVID. What are some of the people that you're hearing at the Home Office and their discussions on inflation sound like?
Yeah, so inflation is one of those. It kind of has. So you just mentioned a ton of tailwinds for why inflation could come around. Whether it was government spending, the fact that just the cost of goods. I mean, the cost of production is going up as plants have been shut down and various things. But also the idea of, with tariffs and other parts, taking away some of the low cost production that we've had throughout the years, all make this case for why yes, we could see some inflation come back to the markets after this. The counter argument would be technology. Technology, if you think about, and again, this is all pre-COVID-19, but I don't know about you, if I went to the mall, for example, and before I was going to buy anything in a store, the first thing I'm doing is pulling out my phone and Googling that exact item and seeing if I could get it for cheaper somewhere else. So technology has not only increased our price discovery abilities, but also efficiencies. You think about artificial intelligence and other ways that have helped mass production bring down costs that kind of counteract inflation. So overall, I mean, Lord Abbett is definitely not calling for a massive spike in inflation in the short term. However, it does remain to be seen is what is the long-term effects of all this spending. So you kind of play it both ways. But I would say in the short term, that's not a fear of Lord Abbett's, that we're going to see a rapid rise in inflation.
Okay. I think the last question that I've heard people talk about when we're doing our meetings, mostly virtual at this point, is what does it mean when we see on television that, the U.S. government is buying bonds or that they're doing things like that? I mean, can you explain in simple terms what that means if someone sees that sort of headline out there, if the U.S. government is buying things, buying bonds, stuff of that nature?
Mm-hmm. Yeah. So the bond markets altogether, what happened in the month of March was just like you would go to Target or Walmart and you'd go to and people would be hoarding toilet paper. I mean, that seemed to be the item where you couldn't find it on the shelves. The same thing was happening in the bond market, but with just cash. People were just hoarding cash. So what happened in the space was you had a ton of supply hit the market, but there was no demand. No one wanted to buy any bonds because they'd rather just be holding cold, hard cash. So what the Federal Reserve has done through these various lending facilities is they now have the ability to step in and provide the demand for the bond market. So what they have come out and said that they will do is, whether it's treasuries, mortgages, commercial paper, corporate bonds, fallen angels, I mean, the list goes on. There's definitely certain requirements around it, but the Fed will go out and be purchasing either individual debt or mostly through ETFs, and that way they can access basket of securities, and they will be purchasing and taking on some of the debt onto their balance sheet. So it doesn't mean that they're going to be the sole buyer in any market. What I equate it to is the Fed is now essentially a lifeguard. They've got up into the lifeguard chair if the fixed income markets are a pool, and they're just overseeing everything and have the ability to go in and rescue if needed. We don't think that that's going to be a case, but now they have the infrastructure set up so that we likely won't have a repeat of what happened in March with the supply-demand imbalance. Does that answer your question?
Yes, awesome
And with
information.
that, Ethan, how much of the change in pricing on the bond? So as everybody has looked at their statements, with cringing eyes over the last couple of months, and we saw some of the bond positions come down. How much would you say that had to do just with the fact that corporations and institutions were hoarding cash and not buying up the supply that was there?
Yeah, so if you look at, for a lot of your investment grade, your high quality bond positions, it was the overwhelming reason. And if you're looking for a percentage, you're talking 90, 95% of the reason why bonds were down was exactly what I just alluded to, that the demand had been wiped away. And what's evident of that is if you look at your returns for those same fixed incomes portfolios that were down, if you look at the returns after March 23rd, which is when the Fed first announced this wave of lending facilities and that they would be buying, most of those bonds have rebounded quite sharply, just off the news that the supply-demand imbalance is getting worked out. So it's going to vary depending on which part of the bond market you're looking at, but particularly in high-quality investment-grade corporate debt, mortgages, and even some treasuries, that it's just the confidence. The Fed, they're the ultimate buyer. They have a blank check, and them stepping into the markets and providing that backstop is what the market needed to just to get back on its feet. And it's the same thing that we saw happen in 2008. So it's a playbook that the Fed has ran before. The only difference is in 2008, it took them 8 months to set up. This time around, it took them, less than 30 days. So definitely a big time effect on the bond market overall.
Thank you.
All right. Well, thanks for that, Ethan. We are running up against the clock, so I just want to say thank you. The role that Lord Abbett has played in our portfolios has been wonderful over this last little bit. It's a large part of the safety positions that so many of our clients have. And so thank you for that role. Thanks for the partnership. Thanks for the time. I don't see any other questions. Just want to remind everybody that on our website, we've got a couple more calls coming up next week. The calls that we will also allow, some streaming of some of these after the fact, but we can't do that for all of them for various reasons. If you have any questions, you can reach out to Brandon or myself. You've got our contact information, or our website is www.mfgteam.com. And like I said, we have a calendar of events on there. So we hope all you guys on the other side here are doing well. Ethan, we thank you for your time, and have a good rest of the week, everybody.